Treasury yields have seen a massive move higher this month. Just recently, in the first week of September, we saw 10-year Treasury note yields hovering, getting as low as 142. And today we settled with them almost 50 basis points higher, and we're only midway through the month. So it's been a very radical move for Treasuries, not necessarily going to be based on the news. It may have been much more of a position shift. At this point, you may have seen longs exiting. I think from a technical perspective, yes, things don't look very positive for price. Seeing yields rally this much so quickly, but there is a lot going on. And some of what we've seen from the Treasury trade over the last, call it 6 months, has been expectations for the what-if scenario. And right now they haven't come to fruition. So with a Fed meeting next week, with China and U.S. trade still under whether or not they're going to resolve all their issues, we've got some on the table, some not. You've got Brexit down the road. You've got a stock market that is very optimistic right now, nearing its all-time highs. So yes, Treasury yields are starting to creep higher. I don't know how long this could last, and we're going to get a key insight to how long it might last when the Fed meets next week. So right now, Treasury yields from a technical perspective, you're seeing a lot of selling come in. I think there is going to be a buying opportunity when the dust settles, but the dust hasn't quite settled yet. Likely will do so just ahead of next week's Fed meeting. And if you look at market volatility, big radical move like this, you would expect to see a big spike in volatility, but we didn't see that. We saw the big spike in volatility when we hit that low yield of 142 earlier in the month. Since then, it's been a slow and steady decline as the market gravitates back towards 2% yield. As we see prices come off, we go back into that old range. Market's has a long memory as to these ranges where it gets very comfortable, and that sort of that 180 to 2% range was one that it was very, very comfortable in. So we are starting to see volatility come off and stay off. It hasn't seen a big spike despite the fact that we've broken out of the never-ending decline in yields. And I think at this point, volatility will be very much directional. As we see yields go up, we will see volatility go down. As we see yields maybe go back lower on some news or event, yes, volatility will go back up. So right now, volatility in the declining mode, but probably not for very long. And last, let's talk about maybe something that could push volatility in Treasury yields around. The Fed. They're going to meet next week. Yeah, they're expected to cut rates, but what are they going to do after that? What is their expectations for possibility of a QE, like we heard from our friends over in Europe? What are they going to be talking about with how Fed policy is going to be affected by the U.S.-China trade? Yeah, things are looking better, but they're certainly not resolved. And lastly, what will the Fed maybe mention about what's going on in Europe and Brexit? That will come up in October, at the end of October, the unofficial Brexit line. So I think at this point, there are still a lot of unclear expectations for down the road. I think the Fed has to be happy with the bond market seeing yields pop up a little bit higher with the idea that they don't have to cut as aggressively. Some of the data has been, okay, we'll call it lukewarm, and that has given them some wiggle room. But at this point, the Fed has to be looking further than the end of the week. They have to be looking more towards the end of the year for growth expectations, what's going to happen with China, what's going to happen with Brexit, and how it's going to affect the domestic economy here, because right now that needs to be the focus. Global growth remains an issue, but U.S. growth does not. However, I think the Fed is going to be keeping its eye very closely on all of those variables, which means it's going to be very difficult to tell which way we're going to go. At this point, I think any sort of suspect or hint of weakness in global growth, in weakness in U.S. trade and China trade negotiations will push yields back lower. At this point, the Fed may not be able to control that. So expect a 25 basis point rate cut, but I don't know if Mr. Powell can talk this market down any further than it has already moved in the last 3 weeks.